Let's talk about the mystery charts and the methodology in action. So here's the mystery chart reveal. This is BB. You can see nice little pullback to the moving average, a Landry light pullback. And this is what happened since the entry's up here at 550. Notice that the stock continued to drop for the most part and bounce a little bit over the last day or two. But in this particular case, since it didn't trigger and it pulled all the way back to this prior little base in here, I decided to go ahead and pass. So no capital was put into harm's way. A while back, I think one of the million little things that I did was track when you don't act. And you're going to be amazed when you go back in and look at the service archives, davelandry.com/archives. And if you want to see the newer ones as they become public, I have a client in Italy, and he's been begging me forever to put them on YouTube. And my apologies for not doing that, but I recently did that. The reason you want to do that is you could translate into any language. So if English is not your native language, you can get these on YouTube and translate them. And if you're a subscriber, obviously, I'll give you those. I'll put those up for you as soon as they're published. And if you're not a subscriber, they will show up within several days to a week, depending on what's in there. Okay, another mystery chart reveal. This is KGC, a gold stock. The parameters are down below. I think it's the middle one here. And we had a Landry light pullback. The entry was up there, stop was down there, and then way up here, if you look, you'll notice that was the initial profit target. Now, in this particular case, after several days of it continuing to pull back, I decided to pass on the trade. Now, it's since rallied, but that's okay. I might be going after some other gold stocks. And I figured that maybe some other gold stocks would set up in the meantime. Excuse me. But anyway, notice it did kind of pull back for a few days into this prior range, and I feel like it lost a little bit of momentum. It was trading well below the 30 EMA, so I went ahead and passed on that one. Now, this was not a mystery chart. This one triggered. I did show this one live last Thursday, and it was a bow tie to the downside. And again, if you go and look at the archives, you'll see a video on this, and this one's on YouTube also, youtube.com/Dave Landry. Anyway, you can see it rolled over. There was a bow tie to the downside. My favorite bow ties, write this down, for shorting or coming off of all-time highs. When you're trading a transitional pattern, you want ideally all-time highs because the most people are trapped on the wrong side of the market when the market begins to implode, of course. So at this particular juncture here, at this high, except for the guy who bought the last tick, everyone who's ever owned this stock is happy, okay? Now, remember, technical analysis doesn't have to be that technical, and it doesn't have to be all this mumbo jumbo and all this other thing, all these other things, and all the buzzwords. Now, ooh, AI, we're using AI now. It's like, oh yeah, whatever. I want to make the universal sign for it. Well, better not. But when you boil it all down, you're just looking at the trading that occurred, okay? And there are people behind the bars. And you think from a psychological perspective, what's going through their heads or what's likely going through their heads. Obviously, you don't know, and all predictions about the future, a lot of shit can happen between now and then, as I say every day. I'm borrowing a line again from Greg Morris. But it does give you a framework to work around, and some sort of, there's not a whole lot of logic in markets, but there is a little logic, and look at the psychology of the players. So anybody who bought in this big fat range, okay, once you drop below the range, is a hurt and pop. Now, here's the thing. Most people, let's say you're in a trade and it drops, okay, and let's say you're not following proper money management. You're just an average Joe that bought a stock and because you liked it or for whatever reason. Once it begins to drop, you become the mindset, hey, you know, if this thing, your mindset becomes, I should say, hey, if this thing gets back to break even, I'm getting out. And I see it happen all the time from non-trader types, okay? So what happens is when that stock doesn't get back to break even and begins to tumble, they're faced with a tougher and tougher decision. Do they just keep hanging on, hoping to get back to break even, or do they bail? Is the psychological damage enough to force them to bail out? And the other thing is they might need money. You don't know their situation or whatever. And in the needing money thing, that's kind of dovetails in what Tom McClellan's mother said a while back, a long time ago. Anyway, some people buy, paraphrasing, Some people buy, everybody uses timing. Some people buy when they have money. Some people sell when they need money, and others use far more sophisticated methods. So if the stock continues to drop, they might need money and be forced out. So anyway, long story, endless. I like transitional patterns on the short side coming up for all-time highs. So you can see the bow ties were in uptrend, proper order. That means the 10 is greater than 20 and the 20 is greater than 30. 10 is simple, 20 is exponential, 30 is exponential. I know I hate to say this over and over again, but as soon as I don't, I'm going to get emails. Hey, Dave, what are those bow tie moving averages? Anyway, so bow tie happens, kind of looks like a bow tie, right? Where the moving averages come together and spread out, going from uptrend proper order to downtrend proper order fairly quickly. My wife was eating some spaghetti, and as I passed through the house, I'm like, oh, you're not gonna eat that sausage? I'll take it. So now I'm drinking water here. Anyway, the stop was up there, the entry was down here, and the initial profit target was way down here. And again, you can review these archives on dailylandry.com or my YouTube channel, dailylandry.com/archives or YouTube, youtube.com/Dave Landry. But anyway, went from uptrend proper order to downtrend proper order fairly quickly. Now, this little indicator I have on the bottom, or as I also like to call them, illustrator, just shows you whether or not you're in uptrend proper order and or downtrend or not. So here you can see the 10 is obviously well above the 20 and the 20 is above the 30. So as long as that happens, this is going to continue to count magnitude. This is in stock charts. There's a plug-in there. It is free right now. I keep threatening to charge for it. I never got around to doing that. But I might actually flip the switch on that and charge for it. So if you want it, I shouldn't be saying this. Go ahead and get it now. And tell stock charts thank you for letting me have that for free. Drop them a line. Anyway, when it goes from uptrend to downtrend fairly quickly, it suggests that the tides have changed, so to speak. Everything was pretty bullish just a few weeks ago, okay? And then now we flip back over to bearish. And also, my Kunash just slipped out. I said bearish. I hope I'm not going to be saying bearish too often, but futures are down 101, almost 102, so I might be saying that quite a bit. Anyway, so we flipped over to downtrend proper order, and then to complete the setup, you need a higher high and a higher low, ideally. Every now and then you get a wide range bar down, like right here, and you'll just make a higher low, okay? Now, the entry again, 23.25. Let me show you what happened and how I played it. Now, I worked to follow the system, at least in my what I call my model account, which is real money, by the way, as closely as possible. I have the 100K hypothetical model, but I also take the actual trades just so I'm practicing what I preach, and I will take them across multiple accounts. In this particular case, it had what I call an entry nick, okay? So you come in and you're like, okay, I know I need a short Carnival today, but let me just see what happens. It's like, oh, I got a trigger, and by the time I'm getting my orders ready to go, I noticed that it already began to rally. So I said, okay, two things. One, I do apply a little discretion even when I'm trying to keep it as mechanical as possible in this model account. And a little discretion would be, especially like on the long side, if you have an entry nick, okay, where it just kind of barely hits that entry. In this case, it was 2 cents on the short side, obviously. But if it barely hits the entry and then comes back in, then you have a decision to make, like, okay, do I still want to go with this? Do I want to put in a little bit higher entry above that intraday high, which is a good thing to do, and wait for a re-entry, so to speak. In this particular case, I said, okay, well, let me just take a look at the options. And when you're shorting, and I know I'm opening up a can of worms here, okay, because options are incredibly complex. But when you're shorting, I would always recommend you go in and look at what the options are. And one thing I'm a big fan of is deep in the money options as a substitution for stock. So in this particular case, I'm like, okay, well, their February puts look like they're pretty cheap. 23, that's half a point below the market, or 25 cents below the market, I think, at the time. And I'm like, that's okay. I think for 11 cents an option, which would be $11 total per contract, it might be worth a shot. And I have all day today being last Thursday, and Friday for this thing to move enough to make it worthwhile. Now, in a case like this, I'll use a 2 times flip out. And later in the day, it was actually down to like 2 cents. And I did do a little bad behavior here, which I would admit to. But I actually thought for a second, it's like, boy, at 2 cents, just for shits and giggles, what if I buy 10 options? I don't know, $20 or 20 options at 2, $40, and then flip them out at 4 to pay for my position. You got to be really careful when you start doing that. You can't get a little bit pregnant, and I've been guilty of that S&G type of trading quite a bit, but just be super careful when you do that. As I've said before, because I already sort of, in this particular case, I already sort of violated some rules, which I'll explain to you in a second. But since I already kind of violated some rules, it's like I didn't want to exacerbate the situation and make things even worse. So I decided on passing on that behavior. The point I was going to make is if you are going to do that S&G kind of trading, make sure it's so small, and also infrequent, but make sure it's so small to where if you lose in the trade, like in that case, let's say I'd bought 20 contracts, so that's $40 plus commissions would probably add up a little. Let's say at least $50. Then if I lose those $50, it's not going to change my lifestyle. We'll have pizza instead of steak on Friday nights, which my wife likes just as much. Anyway, so I decided not to do that extra S&G trades, but I did open up another 6 contracts at 6 cents. That was a little bit later in the day. I'm not sure exactly why I did that. I know early on when I opened this trade, and this is what might have led to the bad behavior, is I was only, and I'm just trying to figure out psychologically, I didn't take really good notes on this particular one, but another shame there. But I was supposed to have 5 contracts on this, and then after I bought them, I got to thinking, well, that's an odd number. Okay, if I'm going to flip out half at some point, I need 6. So I bought that extra contract, and then the other 6 contracts at 6 cents, $36, was the kind of S&G kind of bad behavior type of trade. I know it's like, David, that scaling down. It's like, yeah, it's scaling in, or whatever you want to call that, averaging down. And so that's kind of some bad behavior there. But I think I kept it to less than $100, and that was kind of the ultimate goal, is say, okay, if I'm going to go in and short this, I'm going to spend $2,000 potentially, or risk $2,000 potentially, or possibly a lot more on the short side, so I could buy these options pretty cheap. It will get me in the stock for 2 days. Okay, if the stock implodes, I've beat the system, so to speak. If it doesn't, then I can reevaluate the situation, and I'm only out about $100. Now, what's interesting, what happened was, so those were the 23s, okay, and obviously they expired worthless. Now, going into Monday, and here's the thing you got to think about when you trading is making decisions and living with them. Life is making decisions and living with them. Deciding to eat a piece of sausage 5 minutes before I go live has me drinking a lot of water, which I don't want to do during my presentation. But I said, okay, well, applying a little discretion to this, the fact that it didn't officially, it triggered officially, but it wasn't like a well trigger. Okay, it was only 2 cents. I said, okay, I'm going to live with the fact that Monday morning this thing might implode and I don't have a position, and I'll reevaluate it then. Now, fortunately, I was able to come in and reevaluate the situation, and when the market began to sell off a little bit, I went ahead and put on some deep in the money puts, okay, to give me a delta of 100, so it acts like 100 shares per contract, and I bought those at 214, okay. Now, again, I'm not sure why I bought 7. I should have only bought 6, but I bought 7. And so 7 contracts. Now, they're only a week out, or actually 4 days out, but I figured that the extrinsic value or cost, I should say, wasn't that much compared to where it was in the money. So you were a couple of points in the money, okay, at the time. And I'm like, all right, well, that's not a huge difference, okay? how much extrinsic I have to pay on top of that. So I figured it might be worth a shot. So fortunately, the next day, I was able to flip out 3 of those puts at 385. Now, my goal was to flip out half, okay, at a double, and I had a resting order in place at 428, which would have triggered later in the day, but I got to thinking that, am I splitting hairs with this? So I started bumping that ass down until I finally got filled. And my reasoning is, okay, let me get the lion's share of the money back to pay for that option position. If it makes double, then it's 100%, right? But maybe I could pay for 85 or 90% of that options position by scaling out, okay? And then the real money is going to be in the second loaf. And where are we now? We're down to the point, so that's good. So that's beginning to work. So I've got 4 left, so that's an extra $400. You know, knock on wood. Come in. I need some new jokes. Anyway, so that's the trade. Now, the original trade, I lost $101. Technically, I should have only lost about $50 on that. And I think at $50, and let me know if you disagree whether this is bad behavior or not, but I think at $50, for me to maintain a position for nearly 2 full days versus a $2,000 capital outlay plus, because remember, short side, let's say something happens tomorrow, and I'm thinking of morbid things. I need to think of something less morbid. Think of something happens to another cruise liner, right? That stock could easily skyrocket. So, but I ended up losing $101 in the first trade, which a little bit of guilt there. Should have only lost about 50. And then the initial outlay on those 7 contracts on Monday was $14.98. Okay. Now I did sell off 3, okay, at 385. So out of that 14.98, like I said a second ago, I made back, I guess, about 85 or 80% of that at 11.55. And then you take out the 642 that I paid for them. So that's $513 in profits. Now, adding in that money I lost last week, plus the cost of the options, and then we take out the profits, the worst case scenario would be a $444 loss. And what I probably should do is, and I don't claim to be an options guru, but what I probably should do is, as it continues to drop, maybe I should scale out or roll down, not scale out, but maybe I should roll down those options. And so I'll evaluate that later today and report back, okay? Your delta was way more than your theta, so yes, it was a good move. All right, there you go. What is theta? Time decay? I know what gamma is. Theta is time decay, right? Theta is the cost of time. Okay, that's interesting. So probably need to talk to you a little bit about that. Options are so complex, and one reason I'm always hesitant to talk about options is if you know options, you probably shake your head like this idiot, you know. And if you don't know options, you're like, what is this idiot talking about? So it's an interesting thing. How do you gauge the cost of time though? And how does delta work into that? Okay. But I felt like maybe we're coming to the same point when you're coming through it through math, and I'm coming through it a little bit more by feeling. I'm kind of like, okay, how much am I paying extrinsic, okay, which I guess is extrinsic, which is the money above what the option is actually worth. So if you're 2 points in the money and you're paying an extra 14 cents, you're paying 14 cents for the insurance, so to speak, to hold those options, to hold the position, so to speak, as opposed to have an outright position where you could lose a hell of a lot more money. Anyway, intrinsic is the real money portion of the position. Yes, and extrinsic is the part that is what I call the fluff off, the fluff you're paying. But yeah, options get really complicated really quick. And the other thing too, it's like, okay, well, Dave, you need to use the option model. Well, I knew someone years ago who created an options model, and he ended up selling it, and he's later regretted it because he sold it under the guise that, don't kill the market with this, and they killed the market. And his thinking is he made $1 billion mistake in doing that. Anyway, that's a little ancillary story. It means nothing. That's a little superfluous. What's that word? But anyway, the thing is, the point I was trying to get to is everybody has the same option model. Okay. So I'm not sure that you have an advantage over the other, but if you feel like your stock picking is pretty good and you feel like it can make a move and you feel like it's worth paying that extrinsic or that fluff on the option, especially when you compare it to your outright potential risk, then it's worthwhile. It gets really complicated really fast. Okay, what happens if this market has a mother all bounces before I take some other action later today, possibly? Okay, and then that money evaporates, and then Friday the damn thing tanks, or Friday, after hours it tanks, right? And then I'm like, well, I have no position once again. So it gets really complicated really fast. Tread lightly if you're going to do this, but I would always encourage you to look at the deep in the money options as a substitution for stock. So to me, that's kind of an easy way to wrap your head around it. And I don't know the exact math on this one, how it worked out. I should have written down stock pricing all the time. I might have it in my trading journal. I'll look back to it next week. But let's say the option is 2 points in the money and they only want $2.14, which, if memory serves, that's what it was at the time. I'm like, you know what? 14 cents is not a lot to pay for that insurance of being able to sleep at night. Yeah, it's going to suck if I lose $1,400 and a little bit more because I did it in other accounts too, but at least I'll be able to sleep, okay? Extrinsic is a funny money portion, largely consisted of theta and implied volatility. Okay, so theta, yeah, okay, so I see what you're saying. So theta is the amount of time, okay? And the implied volatility is what the market is implying the option should be at. Like lately, I have a little strategy which I haven't completely fleshed out, but I do notice late in the day, and I talked to an S&P trader a while back, and he sort of confirmed what I was thinking. These ETFs get an imbalance in their amount of futures or amount of long or short options, or however they futures contracts, or however they play the equivalents in the S&P. So you got like the spiders or maybe these leverage funds or whatever, especially these leverage funds, I should say. I've noticed like late in the day, I call it the race to the finish, a lot of these contracts will have these big moves. And it was explained to me that you get an imbalance. Now, I don't know, there's no way of knowing who's got an imbalance, but if you're a short ETF and you don't have enough futures, even if the futures are down whatever they were earlier, 101, okay, going into the close, you have to short even more. And he explained to me, that's why futures be creamed, and they get creamed even more during those last 5 minutes because they're forced to do those transactions. But where I was going with that was lately the implieds have been so high on the E-mini options, it's not worthwhile. All right, one thing I've kind of been toying a little bit with is paying attention to the volume buzz on stocks. And I get this from TC, and a while back, someone who, I don't know if he's legit or not, so I don't want to say his name, but we crossed paths somehow. And we were talking on the phone, and he was bragging about how much money he made pre-market off of volume buzz and whatever. And I think he was using them. I don't have the software. It's a free website. I shouldn't tease you with it. But that's where he finds the stocks or whatever. And I think he uses TC for the volume buzz. So that kind of intrigued my interest into this, but I'm not admitting that I'm in the volume just yet. My problem with volume is I could take either side of the coin when it comes to volume, and you're not sure whether or not you're getting true volume. And volume makes a lot of sense if you say, okay, heavy volume stocks going up, that's a good thing. But wouldn't it mean that a lot of people are also selling? And that's kind of like the Dick Orm's ease of movement. He's no longer with us, so God rest his soul, but super nice guy, by the way. But anyway, so that kind of turns everything on its head. But I have noticed that the volume buzz is kind of cool to watch, and I've been watching it in Landry 100. So I put out this post in Facebook, and I think while I was making the post, I actually got triggered into this. Now, Russian doll, just FYI, what you're doing is you've got to pull back like this or something. And this is so crazy. I don't think I would trade this outright, okay? Because it's just so damn crazy. HV of 157. Even ludicrous would say that's ludicrous, right? That's really high. S&P right now, I'm guessing it's probably 15, 16. We'll take a look at that in a second. I'll tell you exactly. But anyway, your job is to try to get in on this pullback intraday. It's almost like you're front running the daily setup, but you're just doing it for an intraday trade. Now, I remember looking at this, and I don't know how this volume buzz is calculated, but it seems to me like it was much more than 123%. Oh, wait, 191%. Okay, I'm pointing the wrong one. That's why. So you got about 200%, which I'm guessing is twice the normal volume on this, and it's beginning to rally, and the market's oversold. It's kind of like the ball being pushed underwater, right? There's a chance for it to pop back up. Now, we're not betting the farm, okay, number one. And number two, we're not trying to establish a position trade, although it can be possibly a way to get a little bit of a head start on a position trade. I'm not sure I would go in, if you were going in at, I don't know how many shares you do on this, but let's say 1,000, whatever. I don't think I'd buy a whole 1,000 shares, which probably would be too much for the stock. But anyway, I wouldn't buy that all at once if you're doing some sort of Russian doll with the attempt of turning it into a longer term trade. But in this particular case, I'm like, you know what? And I think if you look at that post that I made on Facebook, you'll see. That's in the Facebook group, by the way. You do have to be at least a gold member of DaveLandry.com. And I think it's well worth it. I spent a lot of time in there talking about markets. Not that I'm the Grand Pumbaa anything, but I've got a lot of good people in there, a lot of smart people that I get a lot of trade ideas from, one of which I'll show you in just one second. Okay, buckwheat. So here's the trades I made on that. I only did 200 shares. I just did this in a very small way. So the buy was there when it began to rally. And then what happened was the trailing stop I was using knocked me out. Now remember, I hit a buy and I got an alert that I hit the IPT and I already had a trailing stop in there. I think it was a 1.5 point trailing stop. And I just let it go. And toward the end of the day, I'm like, or an hour or two later when I checked back on it, I'm like, holy crap, I probably got 5 or 6 points in this thing. And unfortunately, I'd gotten stopped out. So evidently it must have spiked and came right back in. So like I said, I'm not sure exactly how that went down. I should know. So I said shame on that. Another one, admission of guilt there, exactly how I got stopped out and why. But overall, I ended up making $226. So it's better than a poke in the eye. And as you can see, if I had paid a little bit better attention to what's happening, I probably would have made a heck of a lot more before it eventually stopped out. But sometimes these little Russian doll type of trades, where I call it a Russian doll because you look at a pattern inside of a pattern, okay? So you've got the bigger picture daily pattern working for you, and maybe even a weekly pattern working for you, and then you're going in on an intraday pattern. And part of the inspiration in that was years ago, I worked with, I was helping him pick stocks, but I worked with a trader, and he would get everything behind him, daily, weekly, etc. And he'd go and he'd take, I wouldn't say a scalp, but a little bit more than a scalp in the market, an intraday trade. So he had as much behind him as possible. So that's kind of the Russian doll setup, and you are kind of front running that other setup. Anyway, I had a buy at B setup I want to follow up on. I'd forgotten to follow up on this one last week. So this is one that we have been talking about, and I don't have the slide here, but John Ross is our resident IPO expert. He's taken my stuff and done really well with it. I'm kind of blown away, and I love when people do that. Used to, like I said one time, somebody took my stuff and was trading low price stocks when the market was blowing and going. This was probably 20 years ago. And I was speaking right around that time in New Orleans, and I told the group that it felt like somebody stole my bicycle off the front porch and rode around the block, and they got in from my house, they popped the wheelie. Anyway, but good for them, and good for John for making this work. And he brought this up in the group. Now, remember, we have the day one rule, which states that if day one makes the high for the week, okay, then it must also close above that high. So normally with the buy at B, you would just be buying a new closing high. And by the way, less than $5, I'm pretty skeptical with IPOs when it comes to buying them, with the buy at B at least. And then more than $30, which used to be the 20, in case you've been around forever, $20 roll amounts, a $30 roll, I tend to pass on them with the buy at B. It's my, through empirical observations, it seems like that those numbers, less than 5 or more than 30, the buy at B doesn't work as well. But anyway, here we have an NCH, which is a new closing high, okay? So technically, or I should say, if day one, if let's say day two was higher than day one, like this, I don't know how it's gonna look on the camera, then this is the day two high, this is the day one high, okay? Then you no longer have to worry about that day one rule. But in this particular case, since day one set the high for the week, it has to also close above that high. So the buy was right there. Now, I didn't buy it on that day because the trigger, so to speak, was kind of marginal. It was barely above that prior high. But technically, because of the day one rule, you just need to close even a cent above this high, okay? As opposed to normally you would buy it at the new closing high, okay? So I went in on the next day and I bought 400 shares, okay, in this particular account at least. And my stop was down there at a 2-point initial profit target. And when that IPT was hit, I sold half, okay? So I had 2 points IPT, 2-point stop. Initial profit target is only half we're selling, right? And then you bring the rest of that up to break even when that happens. So you can see 829, 400 shares, 1029, 200 shares taken off, okay? Okay, now, any questions on any of that so far? You'll probably see fewer and fewer of those setups because the market is questionable at best, down 108. So here's another post. I'm back in IPUSD. It's one of the shitcoins, SHYT. And as I said last week, this is my shitcoin to Bitcoin strategy, where I take, as opposed to plugging a miner in and have it a computer miner in and have it lose money, I'm going to trade shitcoins and take a crumb off of each trade that works, obviously, and put it into Bitcoin. So $25 ended up in Bitcoin. The entry was here. In these crypto pairs, I just use a 20% initial profit target. Obviously, something like Bitcoin, 20% would be kind of crazy, but these little shit coins can move really fast, really quickly. So $25 was mined, so to speak, to Bitcoin. And I hate to use the word hope, but hopefully this will be a good problem to have. Hopefully at some point, that amount of Bitcoin that can be made from these shitcoin trades could be something that's worthwhile. And I might have gotten to thinking about this. I know that some of the shitcoin mining, I think most of those guys, they don't want to get paid in those shitcoins. They want to get paid in Bitcoin. And I think they ended up getting, I think that's how that works out. Maybe that's where I got the idea. I don't know. And one thing I did try initially was I did try keeping money in those native pairs. Okay, so in this particular case, I would keep what was much more at the time. Let's say I keep $50 worth of IP just in case it went up 1,000% or whatever. But I found out that that just was kind of a Chinese water torture because a lot of these things just roll over and go to zero. You'll see that when we get the live charts in just 1 second. Anyway, I decided to get out the rest. I did ride out this first little correction in here. Okay. And remember, we're at least break even. Okay. And I felt like I wanted to get something out of the trade, and I rode out the correction. And when it began to implode a little bit again, I went ahead, just cleaned house. Everything was kind of ugly then, it's kind of like a baby being thrown out with the bathwater type of market in stocks and everywhere else. Anyway, so I only put $1,000 in this. I would keep it small on these shitcoin trades and all, because it's such a volatile, such a crazy thing to trade. And I'm also trying to be cool and like trying to parlay some small accounts here and see what happens. But anyway, so I made 89 on a second loaf, and I took 25 out of that too, which is not shown, and I put it into Bitcoin. All right, any questions on all that? Okay. So I promise not to bore you too much with all this. Those are the rules for the TFM 10% system. And that was the last buy back there. You see the last sell was right here. Just look at these rules and that'll explain it to you. And this zone here, these zones are based on the 50-week closing high. So now, especially with this morning's weakness, we're pushing further and further into that greater than 5% zone. Jeff, who's here today, actually inspired me to put these zones in here. And his thinking is, my thinking was if a market drops 10% or more from this 50-week closing high, it could be in a lot of trouble. So that would be 5503 right now, S&Ps, round numbers. And his point is, if you're 5% or more away, then the market could be in trouble, and he likes to at least think about getting out. So the sell would be, based on the rules, a close below the 50-week moving average and 10% or more away from the 50-week closing high. Actually, the sell right here should be down here. So this is a mistake. So this sell here, my bad, should be at 5,500. So the sell and the P's would be 10%. It depends on how you want to look at it. Close below both the 50-week closing high and the 50-week moving average, or the greater of the two, whatever makes more sense to you. So that's wrong right there. So the sell is actually right here. Okay. When I updated the chart, it must have moved higher. So my apologies. Now, the NASDAQ, as I said quite a bit, just for shits and giggles, I bought 100 shares way back on the last trigger in April of 2023. And somebody posted earlier, or yesterday, I guess, in the Facebook group that the NASDAQ's like 100 weeks or something, or forget how many weeks above the 250-day moving average or something like that. And I went in and looked at this 50-week moving average, and you can see it's been above it for a long, long, long time. And I've been in this trade for 101 weeks, which when I went into it, I just thought, hey, we're getting a little rally off of lows. Let's see what happens. And I had no idea it would go that far. So again, the sell's at the wrong spot. The sell's actually down here at 5503. A few weeks back, you can see they were both the same, okay, the 50-week and the 10%. But now that 50-week moving average is climbing up. The reason I added that moving average, by the way, is that I wanted a whipsaw filter. Now, if you start adding more and more and more and more and more and more whipsaw filters, you do something called curve fitting, okay? And you make a beautiful system in hindsight that's going to suck in foresight. Like, as I said before, I told somebody who designed systems that, well, your biggest drawdown is always in front of you. And he got mad at me. I'm going like, he's going to find out, FAFO, what the young folks are saying. So there's the 50. You got to close below the 50 and 10%. So we do have a ways to go on this. I thought we were much closer to a sell signal. Oh, hang on. Okay, I see where I fudged up. This is supposed to be the Qs, okay? That's why it looks funny. This is supposed to be the Qs. I'll bring up the live chart here. Okay, remember I just said that I had thought the 10% sell zone and the moving average were the same, and they are. You can see we're right around 484, okay? Now, one thing that I put out there for discussion, and feel free to discuss it if you're on YouTube, is when I designed the system, I didn't know or think about the fact that Stock Charts uses a calendar chart for their weekly charts. It's kind of an old school way. It's not good or bad. It's just it's kind of interesting because you always have the calendar week on there. And I was just thinking a close below the 50 and the 10% line would be all you needed for a signal, but I didn't think about the chart being a calendar chart. So because it's a calendar chart, instead of like Monday to Monday, Tuesday to Tuesday, Wednesday, Monday, Thursday, Tuesday, Wednesday, Godfather there, it's actually Friday to Friday, okay? So this system can only initiate a sell signal on a Friday. I don't know if that's a flaw or not, but for now, I'm going to take it on a case-by-case basis, okay? Check back often, but for now, I'm going to stick with the original system, so I'm following the original system as it was tested. But anyway, you can see we're getting fairly close to that stop out, and when that happens, or hopefully that doesn't happen, but if that were to happen, then that would be a $5,724 haircut. Now, as I've said before, there's been times where this has had $8,000 drawdowns. So from here to here is a $5,000 plus drawdown. That's going to suck, to put it mildly. I think from here to here was an $8,000 drawdown. I'll still do okay. Don't worry about me. I'll be okay. I think overall the trade's about $15,000 if I'm stopped out, but it was up around 20. And you know, you look at the charts and you're like, oh, you kind of monetize that 20 grand, you know, like, hey, I got 20 grand on this trade. No, you don't, Danny. Landry 100. I'm just buying stocks that are making new closing highs, okay? Not every single one. I'm looking for the higher volatility stocks first, and then I'm going down. I'll give you the formulas if you want for that. It's a pretty simple formula. It's like close minus the close 50 weeks ago, and you take the percentage of that, and one would mean it's 100% of that. And so I'm buying ones, okay, 100% at 50-week closing high. And there's no money management used other than new ones. When new ones come in, looks like we're getting hit some more. 120 on the P's. Wow. But when I find new ones I really like, it might push out some weaker ones, okay? And if they're just weak on if they're weak on their own, they'll get knocked out too. I'll kick them out of the portfolio. As I preach each week, I'm managing this portfolio like a manager would manage employees, okay? You've got 4 employees and 3 are working their ass off and one's sitting on his ass. It's like, well, who are you going to fire? You don't want to fire one of the 3 that are working thinking, well, they're going to burn out and stop working so hard. They might, but you don't know that, right? You probably want to get rid of the guy sitting on his butt. You don't want to keep him along thinking that maybe tomorrow he'll start working, okay? As I said, ad nauseam. Anyway, so again, all these are bought at brand new highs. These numbers are not quite as impressive as they used to be. I've taken out some ones that have gone up like 300 and 400% and then rolled back over at significantly less than that, but still a triple-digit gain. So there's only one right now, to my surprise, still a triple-digit gain. And again, they're all bought at brand new highs, and this buy was done right there. I would not advise you to do this on an individual stock basis with a small portfolio, okay? If you were, make sure you're buying quite a few stocks. I know we had a discussion a while back about how many would it really take to get a representative sample. I don't know how to do that math. I don't know if that math applies to the markets. Maybe it does, maybe it doesn't. But make sure if you are doing something like that, either the market is really blowing and going, and hint, right now it's not. We're down 117 on futures. So make sure that the market's blowing and going, or at least you're buying a bigger portfolio of these and you're actively managing them. So that move there, 176%, but you can see that was much, much more impressive not that long ago. There's no money management in this system. It's just proof of concept. And without boring you too much, if you go and watch last week's presentation, I reiterated all those bullet points, that momentum begets momentum. Momentum ends badly. Boy, has it been ended badly lately. Some of these things are getting whacked, and I've just been taking them out. And what's going to eventually happen, I treat cash as an asset class with this experiment. So if I can't find enough stocks to give me 100, I'll start letting slots open up and they go to cash, so to speak. So 100 slots. In an ideal world, you want 100 stocks. Okay, I think I got 99 in this particular snapshot. But if the market continues to tank like it's doing, like after today, I'll probably have less than 99.